Good morning, dear students. I warmly welcome the Stage 3 students to the first English medium webinar. Today's topic will be Business Environment and Governing Framework under the subject of Finance, Controls and Audit. It is my duty to invite the lecturer today. He is none other than Mr. Tharanga Madupuliyarachi, a lecturer who has worked with AAT Sri Lanka very closely. Also, I would like to mention that AAT Sri Lanka is planning to conduct webinars in all 3 languages in the near future. And if you have a requirement to watch the webinars later on, this will be live on YouTube, and we hope you will pass on the message to all your fellow students. Mr. Tharanga, the webinar is over to you, sir. Thank you.
Okay, thank you. And good morning to all of you, my dear students. Hope you are staying home, staying safe and continuing your studies. So today, as you all of you know, we'll be starting our English medium auditing webinar series. And today I'll be discussing the chapter 1 mainly. And this will be continued likewise. And before moving to the session, I'll quickly go through the subject and the importance of this topic in the auditing subject. So as you guys know, the name of the subject is Financial Controls and Auditing. Previously, it was considered as the PCA, Process Controls and Auditing. Now it's Financial Controls and Auditing. So there are no major changes, some enhancement to the existing parts and some bit of a structural changes are implemented. And as you can see, the name of the subject, Financial Controls and Auditing. So there are 2 parts, Financial Controls and then Auditing. So mainly the financial controls mean how a business organization can look at auditing from their perspective. So don't worry, in the future sessions, I will be discussing very detailed these technical words and all. But for the moment, then when it comes to the auditing part, that's how the auditor is looking at his procedures and his these concepts of auditing in terms of a business organization. So from the 3rd week onwards, we'll be continuing these business processes and then auditing, right? So, but before moving there, during our first and second chapters, we need to discuss some background. We need to do some background work in relating to auditing, that is to identify the business organization, their environment, then the risk attached to them, and most importantly, the concept of corporate governance. So during this week, today's session, and the next week, we'll be discussing these background areas. And from the 3rd week onward, we'll be starting directly moving to this financial control part and the auditing part and the link between these 2. So, okay, with that, let me start our today's session, that is chapter 1. I'll share my screen with you all. Yes. So as you can see, today's our session is Business Environment and Governance Framework. So this is our detailed content of your syllabus, and today we'll be discussing the first one, Business Environment and Governance Framework. Continuously, the next week we'll be discussing the Risk Management Framework, and 3rd week onward we'll be starting internal controls, business processes, and followed by the auditing, other aspects of auditing. So these are the detailed things we're going to discuss today's session, coming under business environment, different types of business organizations, then the external environment, then very important topic, agency theory and stewardship theory, then key components of organization governance framework, then the principle of corporate governance, then duties and functions of direct board of directors, then some committees such as Audit Committee, Remuneration Committee, and finally the importance of corporate governance. So actually out of this session, so I'd like to focus more, give some higher weightage to the areas that is coming under corporate governance functions. So before that, quickly I will go through without taking much time. So the basic fundamental areas like different types of business organization, their objectives, and the external environment affecting to a business organization. So in the context of your exam, so these areas also very important. If you really analyze the past question papers, we have noted that every year you have received a 5-mark question from these areas. So I will discuss few past paper questions as well. So without taking much time, I'll quickly go through these basic areas and focus more and give some higher weightage to the concept of corporate governance. So as you can see, in a business organization, it can be classified into various classification. Like, so this classification can be done by using different measurements. The first measurement is the primary objective of a business organization. So as you guys know, some organizations are doing their operations mainly for 2 objectives. One is obviously the profit motive, profit-oriented business organizations, and the second one is non-profit oriented business organization like these NGOs, and there are so much of other organizations. They are operating for a purpose other than a profit motive, some social benefit or some other purpose without the profit motive objective. So those type of, like, that is also one classification we can use to classify business organization. And the next one is the form of the ownership. So that's also very basic classification. You can divide it into 2, that is government and the public owned organizations, as well as the privately owned organizations. Then the third one is the nature of the business operation. So a very basic classification, we can classify to 3 areas, that is the manufacturing, service, and the trading. So manufacturing, you guys know, what while by inputting some raw materials and processing their business, the main manufacturing process, and get output. So those are, we call the manufacturing business organization. And then the service providing organization means like this educational institutes, consultancy organizations. So they are providing a service. And the third one is the trading, that is mainly the buying and selling companies. If we take as example, a vehicle importer to Sri Lanka, so that's a trading company. And the fourth classification, and bit of an important classification, is the legal status. So this is a good starting point for our subject auditing, and you will understand why we need to discuss these different types of business organization in a topic, in a subject auditing. So this is a good classification, how you can divide business organization in terms of auditing, because there are a set of business organizations which are considered as a separate legal entity. So they are considered as a separate person in front of the law. So at the same time, a set of business organizations are there. They are not considered as a separate legal persons. Most of the time, the company and the owner of the company is considered as a one single person, right? So I will go to the detail. So primary objectives of the organization, nature of the operations we discussed, the form of ownership also, then the legal status. So separate legal entities means the companies which has a separate legal personality from its owners. So the important part of this classification is there are a set of companies where the owner of the company and the business, the company, are 2 different entities. The most of the time, this companies, the corporates can be classified into this classification. Then when it comes to non-separate legal entities, the owner and the company is the same person. So like your sole proprietorships, then partnerships, these type of business organizations are classified under non-separate legal entities. The importance to this classification to your subject auditing is, most of the time this concept of auditing is applied to only to the separate legal entities. So non-separate legal entities are not like not all the time but most of the time excluded from this concept of auditing. But there are a few classifications which we will learn in future. Non-separate legal entities also have to do audit, but mainly the separate legal entities have to, like we can apply these concepts of auditing to such business organizations. So some key concepts relating to these separate legal entities and non-separate legal entities you can see in the next slide. Like you can look at the aspect, the main types of business organization attached to separate legal entities are mainly the limited liability companies and corporates. Non-separate legal entities are the sole proprietorships and partnership. Then the second aspect is the property holding. If the entity is a separate legal entity, property can be held by the name of that company. As an example, let's say a few shareholders open a company like ABC Limited. So that ABC Limited can purchase a land or building on their own name, not by the name of the shareholders. So that's what it simply means. But when it comes to a non-separate legal entities, let's say Mr. A is opening a sole proprietorship company, a small trading company. So that company can't buy properties or land or building on its name. Only the owner of the company, Mr. A, can purchase a land and building on his name. Simple. Then suing and being sued. Let's say the company is facing some legal cases. If a separate legal entity, the case can be filed against the company, not the shareholders or owners of the company. But when it comes to non-separate legal entities, it's other way around. The owner of the company will be sued. In the taxation also similar. In a separate legal entity, the owners will pay tax separately and the company will be taxed separately because company is a separate entity, separate person. But when it comes to non-separate legal entities, most of the times, the business income is the income of that particular individual and he will be paying taxes. And another important part, that is the liability. In a separate legal entity, most of the time, the owners are not personally liable for the debt of the company. So that's why we normally use the word limited liability companies. The company is limited to their liabilities only to the assets they are having. So none of the shareholders or the owners of the company is not liable for the debt of the company. But when it comes to non-separate legal entities, if the company has obtained a loan, the owner of the company or the sole proprietorship or the partnership, they has to personally liable for the debt obtained by the company. So these are few aspects you can compare with the separate legal entity and a non-separate legal entity. Then we can come to the different types of business organization, which you already know as I discussed a few minutes ago. So sole proprietorship, partnership, limited liabilities, and corporations. So I'll quickly go through. Sole proprietorship means one single person is starting a business. That's we call the sole proprietorship. Then a partnership means few people are getting together and start a business and continue it as a partnership. The individuals are called partners and they are continuing a business, so which we can call the partnerships. Then the limited liability companies means a group of people are getting together and sharing the capital of the company and open a business organization. Normally we call it a limited liability company. But the importance here is that owners of the company, simply the shareholders, are different from the company they're gonna start. But in the first two cases, sole proprietorships and partnerships, the owner and the company is the same person. These limited liability companies can be further divided into like private limited companies and public limited companies. So the difference is private limited company means a set of people who are privately known to each other. Let's say some family members, some group of friends, right? So they are getting together and sharing the capital of the company and starting a business organization. So that's what a private limited company. So when it comes to the public limited company, the scope is bigger. That means privately unknown people can be get together and start a business organization. We call it a public limited company. Normally, the founder or the primary shareholder, he can put a newspaper advertisement to request the entire public of the country to join with him to share the capital and be a shareholder or owner of this particular company, which is known as a public limited company. Then finally, the corporations, most of the time govern under the state law. So govern under the government of that country, which will be considered as a corporation. So these 4 types of business organizations can be open, and the classification as we discussed. So importance here is, as I told, not all the companies are not subject to auditing and not applicable to the concepts coming under auditing. So few of these business organizations can be excluded. So that is why in your subject auditing, we are discussing this first chapter as the different types and their classification. And in the next few slides, we'll be discussing their objectives as well. Okay, so the exam focus of this area is, if you can just look at the past papers, in 2018, July, the first question is coming from the types of business organization. So I'll quickly go through. So that's how the exam is, the exam question is coming in your paper. Most of the time, it's a very minor or mini case study, not a case study, but a practical application. Mr. and Mrs. Rupasinghe returned to Sri Lanka after working six years in Canada. So they have saved approximately 10 million and are planning to start up their own business organization. So you are required to state 2 types of business organization that could be started by Mr. and Mrs. Rupasinghe. Then identify 3 common objectives of any business organization. That part B will be discussing in the next slide. So that's how the exam question is coming. So somewhere around 2 marks to 5 marks can be coming from this area, different types of business organization. Likewise, so what are the types of business organization these 2 parties can start? Mainly, they can start a partnership. The husband and wife can be partners and invest their 10 million and start a partnership. At the same time, they can start a private limited company as well. The 2 shareholders are the Mr. Rupasinghe and Mrs. Rupasinghe. They can contribute individually. They can start a private limited business organization as well. Right. Before discussing the next question, I'll go to the next slide. That is the objectives of business organizations. Normally, business organizations are having different objectives. So basically, these 4 objectives can be seen in a profit-oriented business organization, and most importantly, this objective is applicable in different stages of their journey of the business organization. Maybe the life cycle of the business organization, maybe like when they are starting the business organization, the objective is different, and after spending 3-4 years and they have continued and doing business, let's say 3-4 years, then their objective can be a bit of different. Likewise, that's why. So all these 4 objectives can be applied to the same business organization, but at different stages. Now, if we take the first one as a survival, what do you mean by survival is just to continue the business as it is, right? So most of the time, startup business organization, when they are starting, like yesterday they started their business, and their objective is not to grow or not to increase the profit or increase the market share with the other participants of the industry, with the other competitors of the industry. Their main objective is to survive, somehow survive in the market to a certain time period. Then when it comes to the growth, maybe after the surviving period, okay, so now they have established their products around the markets. Now the public knows about their products. So now they can think of growing. So increase in their production and increase in their markets and few advertising campaigns and focusing on more new customers. And they can plan on growing or invest more on some technology. They're growing. Then the next objective in their stage can be the increase in profit. Now probably in the during first 5 years, 1 to 5 years, they will be running at a loss, or maybe they were targeting to come to the break-even point. Break-even point is the point where you don't incur a loss or a profit. Your income is equal with your cost. So maybe they are planning to come to that stage. Maybe after 5 years, they may have come to that stage, and now they are focusing on, okay, increasing profit. Okay, so the final objective is the increasing market share. So once they're establishing the market, and they have spent, let's say, 10, 15 years in the business, now they are only objective. Now they are having enough profits. They are growing. Of course, they are surviving. Now their objective is to increase the market share. If we say, we'll take an example like in the business biscuit industry, Munchie and Maliban. So both are having their objectives, but both are at the maturity stage in their business life cycle. So both of them are trying to increase their market share, not to increase the profit, not to grow, not to survive, to increase their market share, right? So to increase in market share means capturing some other competitors' portion. Let's say these two are having 50-50 market share. So the Munchie is trying to achieve 51% means to capture a 1% from Maliban industry. That's what you meant by the increasing market share. This comes at the maturity industry, maturity level, not only the biscuit, like most of the industries. If we take the banking industry, very competitive industry, you can see that the bigger portion, like we are having 26 commercial banks in Sri Lanka, like bigger portions, bigger market shares are captured by the government banks, and then 3 privately owned big banks, it can be Sampat Commercial. So they are having somewhere around 5 to 10% of the market. So each of these business organizations are fighting or competing to capture another 1% from another competitor. So that's what you simply mean by the increasing market share. So most importantly, you can't simply say that, okay, this type of business organization having the objective of survival, or this type of business organization having the objective of growth. You can't say like that, because these all 4 objectives can be applied to one single company, but at different stages of their life cycle. So that's the important part you have to keep in your mind. Okay, then go back to the exam focus, the past paper questions. In the same question I discussed before, 2018 July, you can see that the part B, identify 3 common objectives of any business organization. So simply you can say that the survival, the increase in profit or market share, and the growth. Now come to this 2017 July question. The Shehan interested in start up his own business, and it's a small snack bar. Initial investment is 50 in the vicinity of the engagement of business. So identify most likely business objective of each of the following stages at the initial state of the business. As I told you, at the initial stages, the objective should be the survival. As a startup, they try to survive in the industry or survive in the market somehow. Then only they can think further about the profit, market shares, and the growth. Likewise, so you can practice those questions. So I'll quickly go to the next areas. That is the external environmental factors that affect the business organization. So this is also a very important area. So what are the factors affecting a business organization? Mainly these factors can be divided into 2 parts, internal and external. So actually the difference between these 2 parts means the control over the company. If we take the internal factors affecting a business organization, it simply means what are the factors which can control by the business organization. The company can control these factors. So the main factors coming here is the culture, mission, resources, capabilities, and leadership, etc. So these factors, the company can change. If the culture is not suitable to the company, they can change the culture. If the mission is not working, they can change the mission. Then the resources are not adequate, or maybe excess in excess, so they can change resources. They change the types of resources. then the capabilities of the company to achieve their goals is not sufficient, so they can change capabilities. The leadership is not good, or leadership is not helping to achieve the objectives of the business organization, so you can just change the leadership of the company. So that's the important part here. In an internal business environment, the factors affecting to the business organization, the company is having a control over them. Then the most important part is the external factors. As I told, the importance here is the company can't control these factors. These are the factors coming from the external environment to the business organization, but the company can't control it. The only thing company can do is manage it. So that is why this is very important. The company has to manage this. Right, in our chapter 2, next one, the risk management, again we'll be discussing different risks coming from this external environment factors. Right, so this is there is a standard way of recognizing these external factors, that is called the PESTEL. P-E-S-T-E-L. P means political, then economical, social, technological, then environmental and legal. Then I think this concept is also evolving over the period. Previously, some years ago, this was just PEST, political, economical, social and technology, but the new concepts were added EL, environmental and legal as well. But in today's context, they were talking about another factor, that is another E, PESTEL. After the technology T, they are having another E, that is the ethics. So that's also has come to a very influencing factor coming from an external environment, but that will be incorporated to the structure after some times. But for the moment, so you have to study and you have to understand the factors coming to your business organization. The influences are come to your business organization from this external environment, that is PESTEL, political, economical, social, technological, environmental and legal. So we will discuss in detail. Actually, these PESTEL will be discussed again so I'll discuss in very detail there when we are discussing the external risk affecting to business organization. But in this session, I'll quickly explain what you mean by these external environments and what are the main factors. If we take political forces, the best example is the government policies, then the tax policies, then the government stabilities. These types of factors or forces are coming under political category. So the important part here is, as I told you, you can't control if the government is introducing a new tax law or government is introducing a new law affecting to your business organization. You can't control it. So somehow you need to manage it. Otherwise, you will have to exit the business. Therefore, like exiting is the last strategy of a business organization. So therefore, you can't think of that. That's the last option. So therefore, somehow you need to manage your business facing or managing these factors. Example, let's say the government introduced a new law to ban polythene. So let's say you are in the polythene industry. So maybe you have to adapt to the new technology or come to the product where the government is suggesting. So you have to improve or enhance your technologies and all those stuff, or otherwise you have to quit. So that's why this is considered as a very important area. Then the second one is economic, inflation, foreign exchange rate, interest rate, then the government spending, demand and supply, unemployment. All the economic factors can be fallen under this category and very important because you don't have control. Let's say you don't have any control over the exchange rate of the economy of the country. Let's say you are engaged with the some export-import related business organization. Let's say you are importing motor vehicle to Sri Lanka and selling. The exchange rate is continuously increasing in a situation like this. Now it has almost reached 200 per dollar. So somehow you need to manage. Otherwise, you have to exit the organization. the business. The third part is the social forces. Here, the main factor is the consumer behaviors and their values and belief in different areas, in different societies. You can see that different beliefs, especially the religious factors are coming under this. Based on their beliefs and values, their consumption can be changed. Right? One of the best example coming under the social factor is this is a global case study. When McDonald's is deciding to first having their branch in India. You guys know that a beef burger is very famous product of them. So they opened a branch in India, but they did not get the expected result because they did not know that most of the Hindu people against of eating beef. So as a result, they couldn't get the expected result. So that's a very big, good example coming under the social factor, because when people believe in something, their consumer patterns also can be impacted. So if you are running a business which has a direct relationship with such a value or consumer behavior, you have to be very careful in conducting your business. In Sri Lanka also, we can see so much of these consumer behaviors, how the community is reacting to certain products, right? These type of things you can see very frequently in Sri Lanka as well. Then the most important part is the technological forces, because you can't escape or you can't get rid of this, because continuously evolving. As a person attached to a commercial bank in Sri Lanka, so I personally experienced the impacts coming from this technology, because every single day this technology is evolving. Let's say now I'll take a bank as an example. If you are running a commercial bank in Sri Lanka, the traditional way of doing banking has gone. These new technologies of, let's say, the ATM card has evolved and come into the picture. Then the entire manual banking operations have been eliminated, and the people used to use their ATM cards and the ATM machine. And now it has come to a level where the people are using their internet banking. They are not even coming to ATM cards. So they are willing to do their banking transaction, log into internet, and that's also expired at the moment. So today's concept is mainly the mobile banking. The people are not even ready to log into the internet at the moment. They want everything in their palm, in their mobile smartphone. So the bank has come to that. So that's how the technology is changing. So if you are in a business organization attached to technology like that, definitely you have to update yourself, your business organization. Then next one is the environmental forces. The importance has increased over the last couple of years. When you are feeling the importance of something, when you are starting to lose it. So the environment is also something like that. So the companies, the business organization were not very concerned, particular about the environment facts, but now they are feeling we are losing the environment. So now the business organization has no option other than managing the impacts they are generating to the environment. So these are also very important. Then the legal forces, mainly the laws coming to applicable to your business organization, some labor laws, then some consumer laws, environment laws. Not only that, some new accounting standards applicable to your business organization, those are also coming under legal forces. So simply what you have to keep in your mind here is you don't have any single control over this. The only thing you can do is manage somehow, like that. So, so with that, the basic areas, the types of business organizations, then their objectives, then finally environment. This environment, as I told earlier, will be discussed again under the risk management as the external risk factors. So there I will explain more examples with some detailed facts. Okay, just look at the exam focus here, your latest question paper, past paper 2020 January, the first question. The Kumar and Mudita are friends, graduated in a business administration. They decided to commence a business of importing and selling stationery nearby their university. So identify two types of suitable business organization Kumar and Mudita can establish to start their business. State 3 economic factors that may affect on the above given business. So one important point you have to keep in your mind, as I told now, if you go to these 6 factors of external environment, not all the companies are facing these 6 factors equally. So there can be companies, the biggest influence can come from one single factor, maybe let's say technology. Now, if we take a bank as example again, the factors coming from the technology is very significant. But when it comes to the environmental factor, so the impact coming from an environmental factor to a bank is very minimal. So that is why in the exam also you have to identify the case given. So what type of business they are going to start. Based on that only, you have to decide, okay, what are the factors affecting to this business organization. So this can be clearly can be seen in your 2019 January question. Assume you are in a business of a software IT company. Then they are asking the question, you are required to identify 2 key factors. So to a IT related, software related business organization, what are the external environment factors affecting? So here you can't, you can write as, let's say, the environmental factor, you can write it, but still for an IT company, you have to question yourself, is that the first factor to affect the business? Obviously no, right? So for an IT company, there can be environmental impacts, but that can be the last, right? So the first one, of course, the technology, as I told you, technology is expired day by day, right? So I have seen another question in one of your past papers in the mobile industry. What are the external factors affecting to your mobile if you are running on a mobile phone industry? Obviously, the number one should be the technological factor. The environmental factor can be the last, right? So that's right. So you have to understand what is the most important factor to write in the exam paper is purely based on the given industry. Understand? So you have to be very careful on those areas. So with that, you can just practice these questions and get a thorough knowledge. So basically what we discuss here is the types of business organization, their objectives, and the external and the internal environments affecting to your business organization. So if you look at the last 5 years past paper, the 10 past papers, the first question of each paper is coming from this chapter, 5-mark question, either from nature, types of business organization, either from objectives of a business organization, or the external environment, not only external, maybe internal as well, the environment affecting the business organization, or a combination. 3-mark question from a environment and a 2-mark question from the objective of the business organization. So that's why the importance is there. In the last 10 past papers, first question has come from this area. So actually I did not spend much time on this area, as these things are like very basic areas coming under the syllabus, but which is very important to start the bigger concepts like auditing and financial controls and all. So this is a good starting point. So with that, I'll move to the next area, that is the corporate governance. But before that, there's another slide which simply explain you it's self-explanatory. Some new trends in a business, the business organizations are these days facing. You can just have a look and have an understanding like this globalization, new science and technology development, this changing in the environments. The environmental factors are becoming more significant with the situations like this, right? Then the liberalization and deregulation can have an understanding on those areas as well. So with that, we'll move to the important area, that is the corporate governance and this agency theory and stewardship theory. Okay. So as you guys, what I think is, so most of you are studying this subject auditing for the first time in your life, because after your A-levels and even in your first stages. Maybe some basic understanding may have come, but a detailed content of auditing and business processes may have not touched by you. So therefore, we need to discuss in this very in detail. And so this is the starting point of this entire concept of auditing, the agency theory and stewardship theory. So simply, I'll tell a small example now in a very layman way. Let's say you are residing in Australia, in Sri Lanka, you don't have anyone. You are residing in Australia with your family, and you have a land, let's say a coconut land in Sri Lanka, because there is no one to look after that coconut land. So you are residing in Australia, the land is in Sri Lanka. So what the first thing you are doing is appointing an agent. You are appointing an employee from Sri Lanka just to look after my coconut land, or if there's any income, just send it to me. Likewise. So this happens, and after a few years, you may realize that now you are in Australia and you are agent in Sri Lanka. You may feel like the transparency of the transaction happened in this coconut land is not very transparent, and the credibility of this agent is day by day getting reduced. Maybe there is no issue like that, but still, as the principal, he is trying to feel like that. And even from the agent's point of view, he may feel that, okay, this particular principal is not coming to Sri Lanka. So likewise, he may tend to do some unethical things, like stealing from the land and having some personal interest on the coconut land and sending only half of the income coming from the coconut land. So there can be some disputes between this principal and the agents. Right? So this is what this conflict, this dispute is what we call the agency conflict. Actually, this agency conflict is the starting point of auditing, right? So here under the agency theory, what you have to learn here is these disputes coming with the principal and the agent. So I'll continue this same example. Now let's say now you are having this credibility issue, transparency issue with the agent. So what's the next step you can do as the principal who's residing in Australia? So you can appoint maybe one of your friends who living in Sri Lanka to look after the operation and whether that particular agent is act on behalf of me. You can request that particular friend. So that's what in a business organization also happen. As I told you, this auditing is applicable. I told that this non-separate separate legal entities, right? So that means the owner of the company and the management of the company are two different parties, right? So in this particular example, the shareholders of the company is like the principal who residing in Australia, and the management, the board of directors, are like the agent occupying in this coconut land in a business organization. So these two are having this credibility and the transparency issue all the time, whether the management, the board of directors are acting on behalf of the shareholders. Shareholders is having that question. Then the board of directors are also might get some disputes like issues like whether they are getting paid well for the contribution they are done from the shareholders. Likewise, the dispute is continued. So as a result, the shareholders can request the board of directors to prepare a financial statement and submit, which will provide transparent information and all the operations and the numbers happening in the business organization. But still, the shareholder not necessarily believe in those numbers, because still the board of directors or the agent can misappropriate the assets or any other thing in the business organization, and now to violate the principle and prepare their own financial statement. So that is why the shareholders can request, okay, just prepare your financial statement, but get it audited. That is, get the opinion of an independent third party. Like in that coconut land story, you appoint your friend, independent third party, to look whether that particular agent in the coconut land is acting on behalf of you. So in a business organization also the same thing happens. The shareholders are appointing auditor, and auditor is conducting their audit based on their performance and everything we will discuss in very detail in future, and provide their opinion whether the financial statements are materially misstated or not. So based on that, the shareholder can believe in those numbers and decide, okay, the particular agent or the board of directors are acting on behalf of them. So this conflict between the principal and agent is what we call this agency conflict and the agency theory. And there's another concept is coming as the stewardship theory. So that means now the same example I'll continue. This particular agent is appointed to look after this coconut land, right? So now this coconut land is under the agent's custody, right? So he is taking care of the asset of that particular principal. Right? In a business organization also, the shareholders have invested their money in the business organization, and those money and the assets related to the purchase by using those money are under the custody of the board of directors. So this concept is what we call the stewardship theory. Right? So you can clearly see it in the slide. The agency occurs when one party, the principal, employs another party, the agent, to perform tasks on behalf of. Right? So like shareholders are appointed board of directors to act on behalf of the shareholders. Like the principal in Australia appointing the agent in Sri Lanka to look after his coconut land. Then the stewardship is the responsibility to take good care of the resources of the organization. Like that agent has a big responsibility to look after that coconut land and send the relevant income without any issues. So likewise in a business organization also, the money invested by shareholders are looked after by the board of directors. So this is what you implement by this agency theory and the stewardship theory, and this is the starting point of your auditing subject. This structure we will discuss in very detail in our third chapter. When we are starting business processes and internal controls, I'll further explain these things in very detail, and this structure helps to link your business processes with the auditing. The two parts of your subject, financial controls and auditing, this structure will help to link together. Likewise. Right. So what is the role of auditor in this structure? So now you know what it is. In the same example, like the principal is appointing one of his friends to look after the coconut land, whether the agent is acting on behalf of him. So in a business organization, it's the auditor. So the shareholders are appointing an auditor, but not like my the casual example, but here now in the casual example, he is a friend of the shareholder, the principal, but when it comes to the business environment, in this corporate governance or the agency theory structure, it has to be a perfectly independent third party. Independent means, this is also a topic we will discuss in very detailed future, but for the moment, independent means the auditor should not have any relationship with the shareholders, with the management or the board of directors, or with the company or the financial statement prepared by the company. Is three ways. In these 3 ways, the auditor has to be independent, and he is perfectly clear, and he should not have any relationship. Let's say he is a one shareholder of the company, auditor, he cannot be, then he is not independent. Let's say his wife is a shareholder of the company, he is not still independent. Let's say his wife is a board of director, who is maybe his wife is the accountant of the company, right? So still he is not independent. Then let's say he is the one who prepared the financial statement of the company, or he may have given some financial advice to the company. Still he is not independent. So that is why, not like in our casual example here, the auditor, the independent third party, has to be perfectly independent and free from any relationship from this concept. So as you can see, so this is the structure. The principal, the shareholders, and or the owners, they have invest money in the company, and at the same time they have appointed set of people as the management of the board of directors, and they are the one who's managing the company. So it's obvious, right? So if you take a company, there can be like 100, 200, maybe 1,000, 2,000 shareholders in that company. All these 2,000 shareholders can't come to a boardroom and manage a business organization. Practically, you can't do that. And practically, you don't have the knowledge to do that. Understand some? Let's say a group of doctors who have invested some money in a business organization, maybe they are not having that particular business management knowledge. So that is why. So they have to appoint a set of people who can like expert in the management. We normally consider as the management or the board of directors of the company. These terms, board of directors and their responsibilities, we will discuss in detail. And so they are managing the company, and this conflict is happening whether these people are acting on behalf of us, right? So then in order to reduce or mitigate this dispute between these two, so what the board of directors or the management can do is prepare financial statement and present it to their shareholders and say, no, look, this is your profit and this is your assets and liabilities. This is what has happened to the money invested by you, right? But still, the shareholder is not necessarily believing those numbers. As I told earlier, these numbers can be manipulated, right? So they can mismanage the company and still prepare financial statements, so which can be totally misleading. No, so that is why the shareholders can appoint this independent third party called the auditor, right, to participate in this process and look at the financial statement and provide his opinion whether the financial statements are true and fair. Simply, whether the financial statements are free from material misstatement, right? So material misstatement means simply the financial statement has to be correct in terms of a material way. It has to be correct. So these terms, terminology and all these things, don't worry, we will discuss when we are starting the auditing, and you will get used to these words. Probably may be new to you, but you will get used to this word once we start the concept, the areas relevant to auditing and other areas. Right? So that's the role of the auditor in this process. Okay, now this entire picture, so this entire structure is, we can consider it as a is the governance framework. Now in a business organization, one set of people has invested money, and one set of people, a different set of people, is managing those money, and obviously a conflict between these two parties are happening. And in order to avoid that dispute, they are supposed to prepare financial statements, and one independent third party is also there in the picture to look at whether this relationship happened perfectly. And not only that, there are some other guidelines and rules as well, which we call the best practice, the corporate governance code, which we'll discuss in the next slide. Right? So this entire concept is called a governance framework. You have created a good framework to govern this relationship between the shareholders and the director, management, board of directors, and the auditor, the company financial statement. The whole set of factors coming in this picture should be well governed. Otherwise, this conflict will be continuing and you can't do business. There can be so much of negative repercussions. So therefore, you have to avoid these conflicts between these parties, and that has to be governed or monitored very closely, which will be done by the Code of Corporate Governance. So this structure, generally we can call a governance framework, generally. So the Code of Corporate Governance will be the governance structure framework we'll be discussing from next slide onward. But generally, this is a governance framework. So there should be 4 elements, obviously, to have a successful governance structure, governance framework. First one is the structure, right? So organizational design and the reporting structures and the structure of committees and charters, all these things has to be perfectly defined in a governance framework, right? So in order to future, you will realize there are a few committees like the Audit Committee, Remuneration Committees will be appointed to eliminate or minimize this dispute of the shareholder and the management, this agency conflict. So a proper structure has to be developed. Then the second one is the oversight responsibility, right? So the clear responsibilities has to be defined of board of directors, shareholders, right? Then these relevant committees we're going to appoint, everything has to be perfectly defined. Then third one is the talent and culture. Of course, to maintain such a structure, the relevant talent should be there, right? So in order to manage the company, that relevant talent should be there in the management team of the board of directors. Now, appointing a group of people to manage the company who doesn't have the knowledge or the talent to maintain, to run the business, so you can't expect to prepare, expect to have a proper business operations and to expecting the board of directors or the management to act on behalf of the shareholders. So without the right talent, they are not doing the right business, right? They are not taking the right business decision. So those are not in favor of the shareholders. It's obvious. And a culture also should be developed in order to maintain that. And finally, last but not the least is the infrastructure. So relevant facilities, policy, procedures, communication, technology, everything has to be clearly there to have a good governance framework. So this is a general, generally in order to have a governance framework, what are the areas we require? Mainly a good structure should be there, then the responsibility has to be clearly stated, and the required talent and the culture should be there, as well as the facilities, the infra has to be there. So if you're having all these four, then we can have a good governance framework to maintain, to make sure the agency conflict is minimized in a business organization. So with that, we can move to the corporate governance, principles of corporate governance. So this is now, as in the previous slide, in general, we discuss a governance framework, and very specifically here, okay, this is the governance framework, the corporate governance, and there are a set of principles described by the Code of Corporate Governance, and we'll be discussing from this point onward. So there are 5 key areas. This entire code of corporate governance is, this entire concept of corporate governance is depend, or the consist of these 5 pillars actually, right? So the first one is to keep the interest of shareholders in mind, because the shareholders are the people who have invested money. So if they have not invested money, there is nothing called a business organization or operation. So there is nothing called an agency relationship, and there is no requirement of a corporate governance structure. So that's right. So you have to always keep in your head the interest of stakeholders in your mind. So they are the number 1. Then they identify the roles of the board of directors. Now the money has been invested by the shareholders, and that money is managed by the board of directors, right? So definitely they should have a clearly mentioned duties, as well as the power should be given to them, as well as the responsibility has come to them. So these things has to be clearly mentioned, and as a director in the board of director, he should clearly know these are my roles. So you can't go beyond that, because you are managing someone else's money in this structure. Then the third pillar is the transparency. Definitely whatever the act or whatever the transaction or event happen in the business organization has to be transparent to the shareholder. There is nothing cannot be there without the transparency. Then fourth one is the treating shareholders equally. As you guys know, there can be, let's say, 1,000 odd shareholders to a company, but these shareholders may have different number of shares. Like the share ownership can be different. One shareholder may have, let's say, 20% of the shareholding, another one is having 5%, another one is having 40% of the shareholders. But to a board of directors, whatever the decision they are taking should be in favor of all the shareholders equally. Let's say like simply a board of director in the board cannot take a decision which is favor only to a shareholder who has a major shareholding of the company. That cannot be done. So The board of directors, they have to treat entire shareholders equally. Then ethical behavior, obviously, you should do what is right. Always you have to ask that question from yourself, whether this is the right thing to do. So that's what this ethics and all we will discuss in very detail in a separate chapter. As an auditor, you are bound by a set of ethics, which we will discuss in very detail, likewise. Okay, in the meantime, if you are facing any doubts or if you have any questions, you can raise the question through the Q&A. I think a chat box is there, ready for you to ask any question. And one question has asked, okay, what is corporate governance, right? So simply now, in order to answer that question, if we go to the this slide, so this is basically a governance structure, a framework which will helps you to reduce the agency conflict. Now, in order to achieve that objective, a set of guidelines, right? A system, simply a system where the companies are directed and controlled. Set of guidelines will be there. So that is what simply you meant by the corporate governance in order to achieve that structure. So simply by looking at the definition, so the corporate governance is the system by which companies are directed and controlled, right? So so under that definition, under that concept, you can see these 5 pillars you have to follow in order to have a good relationship between the agent and the principal, and in the business organization between the shareholder and the manager. Okay, there are a few advantages of having a good corporate governance system. There are mainly 5 advantages. First one is operational efficiencies. Of course, if you are having a good structure, good corporate governance, good way of doing business, obviously your operations are efficient, right? Then the greater transparency you can expect, greater accountability you can expect. Simply, the board of directors are responsible. They are accountable on the decisions they are taking, right? So it's really good to have a clear, good relationship between the principal and the agent. Then the better risk responding abilities. If a solid structure is there in a business organization, obviously, to respond risk, it's really easy, right? Then finally, the less likely to be mismanaged because the governance structure is clearly established. Their responsibilities, duties, and the power given to them are clearly defined. So it's really less likely to be mismanaged. If whatever the transaction or the incident or the event done by the board of directors are clearly transparent to the shareholders, and even independent third parties in the picture. So therefore, the opportunities for the board of directors to mismanage the company is really less. So these are the advantages of having a good corporate governance. Then key players of a governance structure, mainly the shareholders, board of directors, management. And most of the time you may have realized that I have used the 2 terms, board of directors or management, together. Shareholder is in a one end and a board of directors and the management is another end. So this board of directors, now if we like in a business organization, some business organization, we can clearly see 2 layers. In the management side, the board of directors are there. So under the board of directors, a separate management is a corporate management is there. If we take a management structure of a bank, right? So the board of directors are clearly visible, and most of these board of directors are non-executive. They are not participating in the management day-to-day operations. They are like just acting as a monitoring part. Non-executive directors. So under them, there's a set of layers separately is the management, right? But there are some small business organizations. We can see this board of directors and management can coming under one layer as well. Some directors are acting as executive directors. Let's say a finance director is an executive director. He is the monitoring party as well as he is the one who's heading the finance function of the company. Let's say a marketing director can be there. He is looking after all the marketing function of the company. But if we take another big company like a bank, the director is coming under separate layer, and head of marketing or a chief marketing officer is coming under the management layer. So all these players are playing in a governance structure. So there are a few questions coming under the Q&A. So right, first one I gave an answer. What is meant by SME? I'll give an answer to that question at the end of the session, which is a bit of out of the session. Is corporate governance is a strength of a business organization? Of course, it's a strength. Or like the company is managing, right? Company is doing its businesses. Like as I told you, in this business organization, the key important is the relationship between the principal and the agent. So the corporate governance helps to avoid the conflict between these two parties. So if you guys know, it's simple, right? So having a conflict, can you do a good business in a business organization? Can you expect the smooth operation of a business organization? No, right? So that is why. So in order to have a smooth operation of a business organization, you have to make sure that there's a good relationship between the owners and the management of the company. So that is why which is considered as the first benefit of your advantages list coming under corporate governance. Operational efficiency is the first one, the green color shape, right? Operational efficiency. That's why in order to have a smooth operation, you should have a smooth relationship between the shareholders and the board of directors. So that is why corporate governance helping to have a it's advantages to a business organization. Hope you got the answer for the question. Yeah, these are the players. Then in your syllabus, we need to discuss their responsibilities and the duties separately. Coming under each of these participants. Mainly the bigger role is coming under the board of directors. So there's a list to continue. So you can go through and have a clear understanding. I'll quickly go through. The board should meet regularly. Board meetings should be held at least once in every quarter. Word is missing there, sorry, apologies. In every quarter. That's how the code says, but in most of the business organization, every month the board of directors are meeting and discussing the important decisions taken by the management, or if they are acting as the management, they are discussing about the decisions which has to take for the betterment of the shareholders. So every quarterly they have to meet, but in most of the organization, every month they are meeting. Then the chairman's role in preserving good corporate governance is crucial. As the person responsible for running the board, the chairman should preserve order and facilitate the effective discharge of board functions, right? So this board of directors also has a leader called the chairman. He is heading the board of directors and he is responsible most of the actions taken by this or decision taken by this board and its function. If a board is violating a core duty which is attached to them, the chairman has to be responsible. The third one is the board should ensure the availability within its those with sufficient financial acumen and knowledge to the finance guidance on matters of finance, right? So as I told you, this entire relationship between the shareholders and the agents, the first step to mitigate this conflict is to prepare financial statement. These financial statements only audited by the independent third party coming into the picture. So the financial statement plays a key role in this picture to increase the transparency, right? Increase the transparency of this picture, the structure. So therefore, definitely in the board of director, at least one person should be there with the financial knowledge, right? So if you can just have an annual report and read the profiles of the board of directors in one of the PLCs in Sri Lanka, you may find at least one person who is financial. He has a qualification on financial sector, like maybe a chartered accountant or a CMA accountant, ACCA, CMA, right? AAT, or even finance degree. So he should have at least one board of directors should have that knowledge. And as I told you, the technology is playing a bigger role in business organization these days, and now the discussion and the requirement has come, at least one board of director with the technological knowledge is also really important in the board of directors, because now most of the decisions coming in the business organizations are linked with the technology coming in. And most of the big organizations, if you can just look at an annual report of a maybe big bank in Sri Lanka, you may see that one director is obviously the financially capable, knowledgeable director is there, and IT related, technologically related director is also there, but the code is not specifically mentioned. We require such a director, but the financially suitable, qualified person should be there in the board of directors. Then the next one, it is preferable for the board to have a balance of executive and non-executive directors, such that no individual or a small group of individuals can dominate the board decision taking. So here, this board of directors, I told you that the executive directors, the directors who are involving in the management functions. So the code suggest, right? So it says it is preferable, right? Not mandatory. It's preferable if the board of directors can have some non-executive directors as well. That means there should be one or two directors who are not involving in the decision making or the management function of the business organization. Let's say all the directors are executive directors. There are, let's say, 5 directors: marketing director, finance director, IT director, operation director, and let's say another director. And all these 5 directors are taking taking decisions involving in the functions of the business organization. There is a possibility of grouping these 5 directors and dominate the business operations. So therefore, at least one director can be non-executive. He is not involved in the decision making and the management function, and he is independently there to look at the functions done by other directors. So that is a really good control duty if the directors can follow. Right? Then there should be a formal and transparent procedure for the appointment of new directors to the board. You can understand, because otherwise, if there is no formal procedures, the directors can be appointed, like maybe with the lack of knowledge, or maybe just to influence, or just to work in favor of the one or two, a very small set of shareholders. Right? So therefore, there should be formal procedure to appoint a new director. Then all directors should be required to submit themselves for re-election at regular intervals, at least once in every 3 years. Director cannot be appointed or act as the director eternally. Right? Every 3 years time, he has to re-elect himself for the reappointment, and the maximum duration is 9 years. Simply, he can present himself as the reappointment only 3 times. 3 years into 3 times, maximum is 9 years. After 9 years, he has to resign from that directorship. Then board should be on performance periodically. The performance to responsible, satisfactory. The board should periodically appraise their own performance in order to ensure the board responsibilities are satisfactorily discharged. Obviously, they have to appraise like the performance of the company by way of, like, they need to evaluate their performance by way of evaluating the performance of the business organization. Because the main objective is the business organization is to increase the wealth of the maximize the wealth of the shareholders, right? So that's the bigger, the main objective of a director. So director has to evaluate himself by looking at whether we have achieved that objective or we are working toward that objective. Then the 8th one, the shareholder should be kept advised of relevant details in in respect of directors, right? This directors details should be advised to the shareholders, and you can see that if you can take an annual report and see, every annual report has a profile, details of the director boards, their qualification, working experience. So then shareholders know, okay, a suitable person is managing this company, relevant qualification or relevant expert in knowledge is there to manage the business organization. So the board of directors has a duty to advise shareholders about their details. Then finally, the board should be required at least annually to assess the performance of the CEO. Now, who is CEO? And you know that there's a board of directors. The leader of the board of directors is the chairman. And who is CEO then? Chief Executive Officer. I told you that in some business organizations, the board is a different layer and the management is a different layer. Most of the directors are non-executive directors. They are doing a monitoring party, and the next layer is the management, which is maybe the head of operation, head of finance, head of marketing, head of IT, likewise. So the CEO, Chief Executive Officer, is the leader of all these executive management, right? So actually, in a business organization, CEO is considered as the captain of a ship, and he is the one who's directing the ship towards the goal, like a business organization is to running toward achieve a profit to maximize the wealth of shareholders. Likewise, so CEO is the leader. So the board of directors has to evaluate the performance of CEO, because actually the relationship happens between the shareholder and the board of directors. Board of directors are accountable for the functions or the decision taken by the company. Now, let's say the decisions are actually taken and implemented by this management layer that is headed by the CEO, but the accountability is with the board of directors. Therefore, the board of directors has to be very careful on the activities, the functions done by CEO and his team, that is the separate management. So, students, these are the roles or the duties, main duties of directors, which are appearing in the code of the corporate governance code. And there are a lot of other duties as well, but which is important for your exam. These key functions are very important, so you have to make sure you are aware of these functions. Right, so we'll move to the next part, that is the role of shareholder. So mainly there are lesser duties to the shareholder, because shareholder has invested money and the board of directors are managing. So the board of directors has the bigger list of responsibilities and duties, but shareholders also have a duty, which you can see in the slide. The board should use the AGM to communicate with the shareholder and should encourage their participation. So the shareholders should be met at least once a year, and you guys may have seen or heard AGM, annual general meeting. Every organization, public limited organization, has to held their AGM, annual general meeting, in order to communicate their financial performance, and if the shareholders having any issues, was to take some important decisions. So at least once a year, this meeting has to be held. That is the AGM, annual general meeting. In addition to that, in case if some important decision has to be taken, another meeting can be set, which is called an EGM, extraordinary general meeting, right? So here also some set of activities in order to achieve those or to function those, shareholders consent required, then you need to call another meeting called EGM. So at the code says at least once a year you need to meet all the shareholders, and the shareholder responsibility is to encourage the participation. Practically, in most of the cases, very few shareholders are participating for this. Most of the time, the shareholders with minor shareholdings are not participating. But as I told you, all the shareholders are equally treated, should be equally treated. Therefore, their 100% participation should be encouraged. Then the next one, the director should disclose to shareholders all proposed material transactions, right? In the financial, if you take the financial statements, almost all the material transactions and events are appearing in the financial statement. in your main phase of the financial statement, or at least as a disclosure note. It has to be informed to the shareholders. Then individual shareholders should be encouraged to participate in general meetings of companies and exercise their voting rights. So all the decisions should be taken with the shareholders' consent is taken with their voting right. If you are an ordinary shareholder of a company, you will automatically get a voting right. So it can be different from company to company, but maybe let's say one share equal to one voting right, right? If you have a 10% shareholding of a company, you have a 10% voting right. If you raise your hands to vote, the 10% of vote has come from that, right? So the functions will be executed by way of this voting rights, right? So these are the main duties of shareholders, not much, but important. Then there are a few committees this board of directors can create within them, which is prescribed by the corporate governance code, right? So the most important committee is the audit committee. Like out of this, the directors in the board of directors, maybe with the most suitable directors, you can create a subcommittee for some functions of the business organization, right? The first one and the most important one is the audit committee. A listed entity shall have an audit committee comprising of a minimum of two independent non-executive directors in instance where an entity has only two directors in the board. So now the question, now you guys are clear with the concept of executive directors and non-executive directors. Okay. Now the question comes, then who are these independent directors and non-independent directors? Right. So the independent directors means, so before moving there, I'll explain what who is non-independent directors means. The directors who have a non-independent, they are not independent. So that means they have a relationship. So simply the directors who have a shareholding of the company, which we call the non-independent directors. So the independent directors are the shareholders who doesn't have, directors who doesn't have a shareholding of the company, or non-independent directors. Right. So this is the structure of the audit committee. Minimum of two independent non-executive directors, or a non-executive director, majority of whom shall be independent, whichever shall be higher. So you guys can read and understand, right? So then what is the important part here is the major functions of a audit committee, right? There are five main functions coming and five main duties, responsibilities of audit committee. You can see that the first one is overseeing of the preparation and presentation of adequacy of disclosures in the financial statement of a listed entity in accordance with SLASs, right? So to prepare a financial statement in accordance with Sri Lanka accounting standard is the responsibility. The overseeing of such activity, the responsibility lies with the audit committee. Then the overseeing of the entity's compliance with financial reporting requirements, information requirement of the Companies Act, and other relevant financial reporting related regulations and requirements, right? So the Companies Act is considered as the Bible of a business organization. All the things you have to follow, guidelines. If you are running a company, limited liability company, all the regulation requirements are appearing in the Companies Act. You have to comply with those regulations. So the audit committee has the responsibility to make sure there's such compliance with the reporting requirements, Companies Act requirements, or any other regulation. Example, let's say some labor laws, the company is supposed to comply with the labor laws. So the audit committee has a responsibility to make sure the company is complying with such regulations as well. Then third one is overseeing the process to ensure that the entity's internal control and risk management are adequate, right? So we will discuss in detail what is this internal control and risk management. So the audit committee has a responsibility to oversee such functions as well. Then the assessment of the independence and performance of the entity's external auditors. So all the relationship with the auditor, the business organization is also assessed by the audit committee. So all the transaction or the relationship, maybe the communication should go through this audit committee, right? So they are independent. I told you that the auditor has to be perfectly independent from all the relationship with the company. So the the audit committee has a responsibility to assess that independence, right? So if the auditor has some relationship with the company or the shareholders or the management or the financial statement, so the audit committee has to make sure that the appointed auditor does not have any relationship as such. Then finally, to make recommendation to the board pertaining to the appointment, reappointment and removal of external auditors, and to approve the remuneration and terms of engagement of the external auditors. As I told, the activities, the fourth point clearly says about the independence of the auditor. Audit committee is responsible for that. Then the final point is talking about the appointment and reappointment and the removal, the function relating to those and their audit fees and the terms of the engagement, all these things, mainly the communication going through this audit committee, right? So so by having audit committee, there can be few benefits can be achieved to a business organization. So these things I'll quickly go through, you can read and understand. So improved credibility of the financial statement, then increase the public confidence, then strong control environments can be there, skills and knowledge and experience of the audit committee members can be available resources for a business. And most of the time I told that this audit committee is consist of that financially knowledgeable directors, right? So then it may be easier and cheaper to arrange finance, as the presence of an audit committee can give a perception of good corporate governance. So what does it mean? It may be easier and cheaper to arrange finance, right? Sometimes when a business organization is taking financing decisions, the financial providers, maybe let's say bank, so they are having doubts whether this is the right thing, whether the right financing decision has been taken. But if audit committee is there in that particular company, then that financial providers have some confidence that the company is running at a good with a good corporate governance function, which is like audit committee is there to govern or to monitor all the financial related activities. So it's good in that way. Then finally, the internal audit function will report to the audit committee, increasing their independence and adding weight to their recommendations, guys. In addition to these external auditors, you guys know that in a business organization, an internal audit also can be there. Internal audit is an internal employee of the company, whose main responsibility is to make sure proper operations, smooth operations and compliance to these guidelines coming under the operational aspects of the company will be complied or not. He doesn't provide opinions on the financial statement, so which is the responsibility of the external auditor, but internal auditor is mainly internal employee. But if the company is having an audit committee, this internal auditor can be reported to the audit committee, not to the CEO of the company. Understand? Now, being an employee of the company, internal auditor, he is also maybe bound with some internal business policies and practices, and there is an influencing factor from the leadership of the company for him to violate the interest which the company has to make sure against the shareholders' interest. So therefore, if the company is having an audit committee, this internal auditor can be reported to the audit committee, and which will make sure some independence in the internal auditor, because he is not reporting to the CEO of the company or the leadership of the management. As a result, no influencing is coming to the internal auditor in his journey of verifying the operational compliances of the company. Then there are some problems as well. First one is the difficulties the difficulties in recruiting the right non-executive directors who have relevant skills, experience, and sufficient time to become effective member of the committee. So you guys know that being a non-executive director, he is not involving 100% of the business function. He is just monitoring the decisions taken by the management of the company. So therefore, these non-executive directors are not full-time occupied with the company. So therefore, it's a bit difficult to recruit people as the knowledgeable with the well experience in the industry. It's really difficult to recruit such a person to actively participate maybe full time in the decisions of the functions of the company. Then the next one is the cost will be high, as the non-executive directors are normally remunerated and their fees can be quite expensive. With the knowledge and experience, it can be very expensive. Right. Then we'll just look at the exam focus. Before there, I'll just summarize this corporate governance. Is the starting point is the relationship between the directors and the shareholders, that is the agency relationship, because the directors are responsible to take a good care of the assets, the money invested by the shareholders, and there are situations this relationship can be disputed. So that's what you call the agency conflict. To maintain a proper agency relationship, right, have a smooth agency relationship, there is a structure, governing structure should be established, which has some 4 components. Infra, then the you can see that in the our initial slide here. Yeah, the structure, responsibilities, infra, and the talent and the culture. So these elements should be there. So then the corporate governance is coming under this general structure, which is simply defined as a system by which the companies are directed and controlled. Right. So, so corporate governance will help the business organization to have a smooth relationship between the shareholder and the director, and as a result, they'll obviously have smooth operations in the business organization, as we discussed in the last few slides. So that's the summary. If you can just look at the exam context, if you look at the previous past papers, there are like 5-mark questions can have come in several instances as a 5-mark one direct question. As you can see in 2018 January, they have given a small case study, mini case study, and asking what are the functions of these committees and the directors. Likewise, the question can come. And the second way is, if you look at the latest question paper, 2020 January, it has come from as a like a not a mini small minor case study, a 25 marks big case study which attached to this like the financial controls part or the auditing part of your syllabus, and this corporate governance also has come as a part of that question, bigger question. So you can see that in 2020 January, the bigger case study is given, and out of which is a 25-mark question. Out of that 25, they have allocated 6 marks to this corporate governance structure. So you guys can just refer to the question paper 2020 January, and the case study is there. And based on the case study, you have to require to the state 4 guidelines to be followed by directors that have been highlighted by the Code of Best Practice on Corporate Governance, which we discussed for a while ago. The duties of the directors, then state 2 committees that should be established by that particular company. So here, actually, I have included only the Audit Committee. So there's another very important committee, which is the Remuneration Committee. Right, the Remuneration Committee means in order to decide the remuneration of this director, CEO, the management. Now these transactions also highly sensitive. This remuneration part of the directors is very sensitive to have an agency conflict. Let's say the shareholders have appointed a board of directors. Now they are charging a fee which is really abnormal, which is really against the interest of the shareholders, which should be governed and monitored, whether they are charging the right fee, whether the management is charging the right fee. Right? So therefore, in order to monitor these activities, the fees, the remuneration of these key management personnel and the board of directors, there should be another committee called Remuneration Committee. Yes, so with that, we can conclude it. Before that, I'll quickly look at the questions which has come through the Q&A. What is corporate governance? I already explained. Then lessons class. Okay, at what time? Okay. So is corporate governance the strength of a business organization? Of course, yes, I explained. And there was another question. called what is an SME? SME is a small and medium enterprises. So which is actually can classified as a norm, like our basic business organization classification is there. That is like sole proprietorships, partnerships, or the limited liability company or a corporate. So the SME is not coming under such classification, which is the which can be mainly classified as the maybe the capacity of the business organization. So normally in different places which has been defined as now, if the company has invested in generally, if the company has invested more than 2.5 million in their operation, property, plant and equipment, which is considered as SME. And there can be another definition for SME if the company is employing this much of employees, which is considered as SME. Now, in most of the banks in Sri Lanka, they have their separate department who is catering to SME sector, right, providing loans to the SME, small and medium enterprises. So they have their own definition. So the companies which has a revenue of this much, the employees of this much will be considered as a SME, which is mainly the capacity and the strength of the company will be measured by way of this the term SME, small and medium enterprises. Okay. Yes, I think all the questions have been answered. Another one is there. Okay, at what time this will be over? Right. Okay, it's almost over. So I think you have a clear understanding here. Basically, what we discuss is the types of business organizations, objectives, then the external environment and the corporate governance. Actually, these are the backgrounds of our main subject, that is financial controls and auditing. And next week we'll be discussing the risk management, risk governance factors, which is also coming under this background work. And on the third week onward, we'll be really focusing on our subject, that is the financial controls and the auditing and the relationship between these two. And this session will be continued with the picture which we discussed today, that is the relationship between the audit, the board of directors and the management, and where the auditor's role is located. And few more areas will come to this picture in your future sessions when we are starting the financial controls and auditing. So with that, we can wind up today's session. Your chapter 1, very important in the exam context, somewhere around from the basic facts like this nature of business and the types of business environment, there can be a 5-mark question can be expected, and also another 5 to 6 to like 5 to 10 mark between question from the corporate governance can be expected. So therefore, an important area for you to study and understand. So with that, we'll wind up today's session and we'll meet next Sunday. Thank you very much.
Thank you, Mr. Taranga, for a valuable session for our students. As I've mentioned earlier, Mr. Taranga has worked with AAT Sri Lanka closely, and his valuable time spent with us today is highly appreciated. I hope all students have attended, gained good knowledge on the topic we discussed today. And I also hope all will be tuned into our Facebook and YouTube channels for more webinars in the future. Thank you once again and have a wonderful day ahead. Stay safe.
Thank you, Deniba.